multi-billion-dollar Russia gold energy trade is setting the global physical price, gold price, significantly higher than the incestuous derivative.
Now, Andrew, can you update us on, you just mentioned there, the PetroRuble or the PetroRuble trade and how this is altering the paper physical balance?
Yeah, the PetroRuble trade. Yeah, Shane. Yeah, absolutely. Well, what's really not understood here by the paper-centric sellers, misreading the double down official sanction efforts. I mean, these are real double down efforts to interfere in the ruble cross, basically, is that the multi-billion-dollar Russia gold energy trade is setting the global physical price, gold price, significantly higher than the incestuous derivative heavy LBMA price setting PM gold fixes indicate, which again, we've just seen the PM fix that we do. This is usually 3 o'clock at the fixed time. Now, our liquidity providers absolutely confirm that sovereign size arbitrageurs are taking every ounce put on offer at every single PM gold fix. Now, the long awaited paper market price reset process is underway, and ironically, it's the West that's triggered it. Now, bottom line, for many years, Russia and China have surreptitiously milked the undervalued paper market set gold price sufficiently to have become the global physical market price setters. Now, given that the daily LBMA spot market price fix is actually deliverable and the COMEX EFPs feed in to determine this price, traders now realize they have a willing central bank physical market buyer to a price that is consistently between $30 and $60 higher than these EFPs spit out. Now, these arbitrages are going to continue to suck out paper gold credit, convert it into physical, albeit at an increasing premium to spot, exchange it for oil, gas, commodities at a discounted price, sanitize these assets, and then sell them back into the global the supply chains. Now, when trying to understand how hard assets led by physical gold are now reintegrating into the global monetary system, one must really question the current official narrative. When every single news source has an identical narrative, it's healthy to question any such narrative that it's not propaganda, no matter what it is, whether it would be COVID, whether it's anything, whatever it is. And in this case, I think you have to question the single narrative. Look, I want to be sure we're not taking sides here, just focusing on how gold fits into this picture. And completely, geopolitics completely aside, gold and silver were rallying before China put a floor under the gold price. Remember that, Shane? We've been talking about this for a long time. I mean, this bilaterally negotiated Russian central bank anchored gold floor is interesting, as it's created a massive arbitrage opportunity to take this undeliverable leveraged COMEX paper gold price, as we say, EFP'd, into this deliverable 10 times larger spot gold market to buy physical gold, to exchange it with Russia for heavily discounted oil, and to sell this oil into the global market at a massive profit. Now, while this is just the thin end of the wedge, it's not small potatoes, as Western buyers are increasingly cutting themselves off from Russian oil supply too. And it's raised this premium. So they're shooting themselves in the foot consistently, raising the premium for physical oil sold by OPEC plus several dollars above the quoted Dubai benchmark price. Now, the joke is that the buyers of this premium priced oil include the same disingenuous Western buyers paying a premium to sanitize this Russian oil trade. It's just all a sham. And to answer your question, Shane, in our last episode, we put some numbers on this arbitrage trade that really let's update that based on today's action. Now, Brent right there happens to be currently trading at 108. It's been 100, but basically it's 108 today. But liquidity providers holding rubles or gold confirm they can swap these rubles for physical gold for $75 oil, not $108 oil, which represents a 30%, slightly over 30% discount to Brent crude. Now, it can work for any of the many oil markets, but it's to keep it really simple. Let's look at Brent as gold benchmarks this trade, as it benchmarked this trade this morning at an average of 1950 spot. So the 30% discount per ounce of gold bought exactly 26 barrels of oil at that price. Now, not even accounting for the ruble gold price being $50 higher than spot, allowing premiums to be paid above 1950 spot for T+2 Basel III NSFR compliant gold, even if selling this sanitized oil back at market at full price, the net round trip arbitrage profit per ounce, including the profit on the paper to physical spread, was really around $800 an ounce. This is very close to what we looked at last time. It's fairly consistent. Now, obviously, this oil trade is limited as to what is being put on offer at the PM fixes, and that is not everything is being put on offer. So basically, anything that's put on offer has to be deliverable. Now, nevertheless, ultimately, it'll incentivize tons of gold to be bought and bartered for oil. But here's the fly in the psyops ointment. The gold that flows into Russian central banks to pay for the oil squeezes the physical market, sucks out paper market liquidity, and bolsters the US dollar, the ruble US dollar exchange rate. Now, the physical gold transacted is simply on a one-way trip into the Russian central bank, where it bolsters the ruble versus every other fiat currency and builds Russian physical reserves at the expense of the West.